Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts, Josh Sheluk and Colin White, portfolio managers with Verecan Capital Management Inc.
Welcome to the next exciting edition of Barenaked Money. The OG, Josh and Colin here with you today. And we are going to talk about conflict. Now, that's a big word, Josh. Do you want to narrow down what kind of conflicts we're going to talk? Is this going to be like marital advice, that you're going to be giving as a new dad, and how your relationship has changed with your baby mama?
Well, when you said conflict, I was thinking conflict in the Middle East. Is that what we're talking about? Nope. It's much less exciting than that. Conflicts of interest and financial advice.
Sorry if I misled people and kept them here longer than they wanted to be here, but yes, it's probably not as exciting as you were hoping.
Yeah. But there's a lot of that. And I don't know. It's a tough topic for me to really get excited about because I'm kind of bashing the industry that we're a part of and talking about all the warts on what's out there financially. Yeah. It's kind of sad.
Well, no, but I think this is an extraordinarily valuable conversation. Now, as much as we make fun of it and call it boring, it's crucial. You have to understand the business model of the financial world in order to really, increase your chances of getting the outcome you're looking for. And there's been lots of different press, but there's lots of different types of conflicts that are out there. And, so we're going to make an effort today to go through some recent examples and some things we've observed and point out where conflicts happen, how to notice them, and maybe how to protect yourself against them a little bit. Because at the end of the day, we do try to be educational. And I'm sorry if we, for a second, made it sound like this is boring. We're going to save your life today. Give us 30 minutes, we'll save your life. Just maybe build it up like that, get people to stay.
Yeah, that's right. Could be life-changing, that's for sure.
Well, which one did you want to start with? I'm not sure which is your favorite. As usual, you've spent a bit of time reading over these things. Do you want to end with a bang, or do you want to start with a bang? Which bang would you like?
Well, I want to start with a bang. I'd like to start and end with a bang, but you can only have so many bangers in one conversation. So, but let's start with one that's very topical, and I think this was kind of the impetus of us doing this conversation. Is it was reported in the Globe yesterday, I think it was, that this was released, that a fairly prominent financial institution, independent financial wealth management company here in Canada, known as Wellington Altus, one of the senior people at that firm had a large stake in an ETF provider, and that ETF provider's products was being, sounds like, fairly heavily promoted by the company themselves. So it's all hearsay at the moment, and there seems to be a few things that are left to be uncovered. But according to that article, it seemed to be pretty damning.
So why did this come to light, Josh? Why are we noticing this? Why is this not just another piece of flotsam or jetsam floating down the river of conflict that never gets called out?
It's interesting. I don't know why it came to light right now, but this ETF company is effectively defunct at this point, at least the Canadian contingent of this ETF company. And it seems like there's a lot of investors in this ETF company that are going to be short on money. It seems like there was, can we call this fraud? I think it was almost like outright fraud, right? Or like very close to it, the way that the money was kind of shuffled around.
Yeah, they were shut down by the OSC effectively because there was money being moved around inappropriately. And as it turned out at the end of the day, when all of the music stopped, there was money missing. So, I mean, again, the reason this became a story that ended up in the Globe was, you have a firm that is defunct where there's allegations of malfeasance. And what was the figure? It was over 30% of the assets in Canada were held through Wellington Altus. So
from this ETF company,
Yeah, almost 1/3 of the money in that ETF company came from a wealth management firm whose senior leader was a major shareholder in. So the reason that this is being noticed is that there has been this failure. So there's been much more of a lens put to it, going, exactly how did this work? And the reporting,
the failure happened a few months ago, so that's why I was kind of surprised that we're just finding this out now about the maybe conflict of interest or stake that was there.
Yeah, no, absolutely. It took a while for that to figure out. Now, the reporting on its surface on a read actually seems pretty good. I mean, they got right into quoting the relationship disclosure document of the firm, and it seemed to be a rather thorough piece that was written. So I think at the end of the day, the magnitude of what happened is uncertain.
Yeah,
but there's certainly something don't look right. The old expression, it may be legal, but it ain't right. Because again, when you have ownership between companies and one individual is profiting from a client a number of different ways, then and that's fairly common. Like you see a lot of institutions that are manufacturing product that they're then selling for a fee, and there's these layers that are going into it, and the industry says as long as we disclose it, because a part of that piece was, well, hey, it was disclosed. Now the disclosure in the relationship document was something to the effect that an employee of the firm is a minority shareholder,
passive minority shareholder, I think was the exact
passive minority. So again, you could see they'll point at that and say, well, we disclosed it, and that may satisfy the rule of some regulation. But I think society's going to look at that and go, that's no disclosure. Will you stop it? I mean, that does not rise to the magnitude of passing the, what's expected test between two human beings. So, but I think it's the failure that caused people to go digging to uncover this. Because I think, honestly, Josh, if you really dig into a lot of the relationships in Canada, this is not uncommon. It's not uncommon for somebody who's sitting in a position of power, who's giving advice, who's influencing others, is profiting from that in a number of different ways. And I can speak from my own perspective in that I have been approached many, many times in my career about investing in various companies that provide products into the industry. That's not an uncommon conversation. And that's a conflict. Now, whether what the magnitude of that conflict and does it really cause the level of problems that it causes, it's hard to say. I mean, if I buy shares in a publicly traded share in a company, you can argue that I'm being treated like any other investor, and I don't necessarily have any inside knowledge. If I'm offered a private placement from a firm where there's limited opportunities to invest in something, and then I'm put in a position where I can, drive business to that company, that doesn't sound right, does it?
Well, no, it doesn't. What we talked about prior to starting hitting the record button here was there's a magnitude or a degree with which a conflict becomes a problem and other scenarios where it doesn't. Like you or I sitting here and talking about shares of, just to use one company that Verecan actually owns, Shopify. It's like, we don't quite have enough followers yet where we're going to make any impact or create any impact on the value of the shares of Shopify by me and you sitting here talking about it. So that's one where there's maybe, if you dig deep enough, you could say that there's a conflict, but practically speaking, there's nothing that we're going to do to affect that. Whereas if you're right, if it's, company XYZ that's selling software out of the back of the truck and all of a sudden you're promoting that and the sales increase by 50%, then, and you're a shareholder of that company, then it's a lot more direct.
Yeah, I mean, if you take this down to, this was an individual advisor who was running individual client accounts and was found that they were funneling money towards a company that they had a stake in. There's more clear rules around that. That would impact the licensing of that individual. Now, again, the firm where it occurred is likely just going to get a slap on the wrist. I mean, again, the way the regulations work is the advisor is held accountable, and the firm goes, I didn't know they were doing that. So, the firm gets to keep their share of commissions that they earned off of those transactions. The advisor has to give back their share, and his career is over. And the firm moves on by hiring a new upstart advisor to replace the advisor that just got caught doing something. So that's also the reality of how these things get treated. This case here, we have like a senior executive who ostensibly I don't think is actually registered as an advisor, but he's got influence over a large number of advisors and therefore able to exert influence that way. That's one step removed, I think, from what the regulations were intended to be able to notice.
Yeah, well, just see what the effect is or the outcome is in this situation where Wellington Altus, as we said, owned over 30% of the assets for Emerge Canada, which is the ETF provider that's now effectively defunct. And these ETFs were part of some of the managed portfolios that they ran firm-wide for the advisors and their clients. And let's just say Emerge is not a very prominent player in the ETF or asset management market. So for that to start making its way into portfolios or into promotional content or whatever, you have to raise an eyebrow or two.
Well, yeah, and then there's others in Canada that haven't failed, so they haven't made the news. But there are other instances in Canada where you have independent shops who have manufactured private products, whether they're private equity or private debt, and they are promoting those products through their distribution channels and using various means to gather assets into them. And again, to me, as soon as you become, if you want to call yourself an independent advisor and you really are advising, if you start making more money off of one product than another, that's a material conflict. That's reaches the magnitude where it shouldn't be. And just because you disclose it, saying, "Hey, by the way, our firm actually owns the company that we're investing in," that doesn't make it better. Because a true advisor is counted on by the public to advise in their best interest. And by pointing out, it's like, "Hey, I've got this conflict, but we're going to do this anyway." That doesn't make the world. And that, unfortunately, that's the standard a lot of this comes to. As soon as you have a company that is profiting in more than one way from a client, then I think you got to drop the word independent. You're no longer independent. You're now a salesman.
Yeah. Well, we could extend this a little bit past the independent network as well. And it's a bit more of a watered down version of this. But if you walk into a bank branch, for example, and open an investment account, guess what you're going to get? You're going to get a product that's offered by that bank. And even though I think technically there might be more options available to you, you've seen basically every bank that I'm aware of strip down their offering to, if you walk in, if you walk into TD, you're getting a TD mutual fund. If you walk into Royal, you're getting a Royal mutual fund. And I think it went even so far as most of these companies, these banks, were basically outlawing any purchases of non-bank funds. And that got the regulators back up a little bit. I don't know. Was there a resolution to that? Did they backtrack from that at all? Or did the regulators just say, "We don't like this"? And the bank said, "I don't care"?
Well, no, the fight was that the regulators came forth with the know your product, because again, they wanted to hold advisors to a standard that there was a certain amount of diligence being done on any product that was being sold, because they were fighting against advisors selling stuff that they just didn't understand, which was happening all the time. So they brought forward rules that you have to know your product. And here are all the rules about knowing your product. And if you can't know your product, it can't be on your shelf. The bank said, "Well, thank you. We can't know all of these other products. We know our product really well. Ergo, ipso facto, we are fully compliant."
Yeah.
So then the arguments start, "Well, wait, that's not what we meant." "Oh, yes, it is." And yes, there's still a conversation going on about that. But at the end of the day, you can't require an institution to offer third-party products. I don't think you can do that in a free market system. And you hope that there's a market reaction to that. But I think, Josh, this is a good time for us to jump in. And we don't often do this. Let's talk about Verecan for a second, because we have the Verecan funds that we use. And I think that, so people don't call us hypocritical in the comments. We have two pools that we use for most of our client assets, but we've designed those two pools where there's no fee coming back to us. So Verecan does not make more money by using Verecan product. Those are stripped down to just the costs, which is uncommon. And in fact, I've had a few people ask us, like, "Well, why not?" Well, it's just how we decided to do things. We're getting paid to manage money at the client account level, and it's visible. Client sees it. We're not going to hide a fee inside of something else. That's not what we are. So anybody who looks at this podcast and says, "Well, you guys are hypocrites," no, easy, big shooter. The ones we're talking about is when you go and buy at a bank branch and you take a look at the MER inside those mutual funds, there is a management fee being paid for the management of that money. So they're getting paid to manage the money and the fee at the account level. So it's ostensibly they're double dipping, and they're calling it advice. You're going to an advisor to get advised. They're really salespeople. You're going to a salesperson to be sold. But I guess the reason to circle back where I started with the independence was that I think it's easier to see when you walk into a bank branch, you're not talking to an independent.
Yeah.
It's not assumed.
It's
When
more
somebody
understood,
says,
right? Yeah.
exactly, when somebody says, I'm independent, but yet behind the scenes, this is what's going on, that's more disingenuous to me.
Yeah.
And there's more examples of that. And there's regulatory scrutiny going on with a couple of firms in Canada over that exact issue. So I bristle a little bit more at the idea that people are calling themselves independent. And the client goes, well, thank God you're independent, but you end up you're basically in the same soup.
Mm-hmm.
And maybe even worse off because it's even the opacity of it. But yeah, it's a real thing.
Yeah. A lot of this comes back to, as sad as it is, like, how do you get paid?
Yeah.
Explain to me, how do you get paid? And it's not maybe that easy because the industry has made a lot of these things quite opaque, but understanding how the individual and the company is paid and compensated is going to go a long way to try to identify those conflicts of interest. Now, when the relationship disclosure says that there's a passive minority interest for a shareholder, you could probably ask a million questions and never quite arrive at what you need to understand.
Yeah. No, absolutely. And the challenge is where do you go asking the questions and what are the alternatives, right? But the the bigger question I ask, and I've asked this in previous podcasts, is not necessarily where the compensation is, but what's the business model? How is this institution profiting off you? So you have the person you're sitting in front of and the advice that they're giving, they're being compensated for the advice, and that compensation is going to drive the advice that they give. But then even to sit back further and say, what's the whole business model of this organization? Like, where's the organization making money? Okay, well, they're taking a piece of the money that's being generated by this advisor in front of me, the salesperson. They're making it off of the product that they're selling me, and then they're selling my data to a third party, so Facebook can market to me, and try to get me to buy sunglasses or something. Just understanding the business model of what you're getting involved in. Like, we've had the conversation about the zero commission trading on
Yep.
some of the platforms, and how they sell the order flow, and then you get front run on all of your orders, and everything's not quite as efficient as it could be. And then they provide you with, here's the top 10 traded stocks today. And, here's the top 5 tech stocks.
And you get a gold star the more trades that you do.
And then there's confetti, and then there's the dancing pig. I always like it when you get to the dancing pig. So but you're like, oh my God, they make this so fun. What's their business model?
Yeah.
What's their business model? Always, what is their business model? Oh, wait, I'm the product. I didn't pay to be here. I'm the product. Oh, okay. Well, how are they milking me? Like, where exactly is the milking machine attached? Once you understand that, you're at least a little equipped to exist in that world.
Well, you mentioned Facebook. Like, a lot of this stuff it's interesting because you get so much stuff for free, quote unquote, free these days, right? Google search, free. Facebook, free. Twitter, free news, all this stuff. But to your point, what's the business model? Like, how am I losing? It's like that thing. It's like, I know I'm getting screwed here, but how are you screwing me? Like, just explain to me, because I know something's going on. So yeah, like these are advertising businesses, really, at the end of the day, and they're making a tremendous amount of money advertising things to you that you may or may not want or need. I guess since the advertising is valuable to them, people are buying stuff. So it's working.
Well, yeah, just so you remember, that's a Seinfeld episode you're quoting,
Okay.
And it was so we tried to give Kramer a points card. He goes, well, why not? It's like, I don't know how I'm losing, but I know I'm losing.
That's right. That's right. Yeah. Loyalty rewards, same thing. Yeah.
Yeah, no, absolutely. But no, I mean, it's good to see these conflicts hit the news like this. Now, hopefully this hits at a level of magnitude that, oh, Josh, you're smirking at me. You think that nothing's going to happen. I choose to be optimistic and say that this is so egregious. This is so visible. This is such a travesty on the Canadian investing public that there will be change. You think not?
No, I think the regulators are always responding to these things when they come up. But the thing is, it's always a response. It's hard to be proactive for creative conflicts of interest that haven't even been thought of yet. So I don't blame them entirely. So I imagine that they'll come in and do something if all of the facts here are shown to be true.
Yeah. Oh, no,
But
listen, absolutely.
is
Yeah.
it going to be as severe as it needs to be? I don't know. Like sometimes they're too light-handed, other times they're too heavy-handed. It's tough to strike the right balance and to ensure that this type of thing doesn't happen again.
Well, the other challenge you have in Canada is that the Canadian financial sector is quite under invested in and is quite underfunded. And there's a lot of room for improvement. So, it's almost as if, well, if we in the financial industry want it to be better, we're going to have to invest more in it in order to get, the better fintech in Canada. So there's a little bit of you could say that through one light, it's kind of an altruistic, yes, we need to invest in our industry to make it better. You know, that's the better angels. The more evil angels is like, excellent, we're going to own the whole thing. We're going to be in great shape. And you're right, it's evolving so quickly. And again, the regulators have a tough job to kind of figure out, all right, how far can we go? Baby with the bathwater kind of thing. And there's always unintended rules. And I go back to the know your product thing, which on its face, that was a really, really big improvement. And that was a really, really good idea. The unintended consequence that the banks were going to shut their shelf was like, well, shit. All right, fine.
Yeah.
I guess we're not done. There's more work to do here.
Yeah.
And I don't know if that could have been completely foreseen. Part of me says, yeah, somebody in the room had to say this is what was going to happen. And maybe it's just decided this was going to be a hill they'd have to climb another day.
Mhm.
Or, maybe they're waiting for the market to adjust and have people say, you know what, screw it. I'm not going to go into, a bank branch and have just one fund offered to me. That's going to hopefully drive all these people to independent advice all across Canada.
Yeah.
Maybe that's the outcome.
Yeah. It's a bit of a whack-a-mole thing, for sure. Yeah.
That's a really nice visual. Thank you.
No problem. Can I throw a couple more randomly selected conflicts that exist out there at you?
I would be disappointed if you didn't.
Yeah, because I was thinking about this, and again, it all comes down to the same thing. Like, what's the business model? How are you compensated? Things like that. But there's been quite a proliferation of private investment products that are out there over. Really, it's been proliferating, I'd say, probably over the last 5 years, but especially over the last couple of years, I've heard more and more of this stuff promoted. And so when we say private investment, it means it's not traded on an exchange, the investment itself. So there's no day-to-day pricing on these investments that underlie these products. Most of these products, you accrue as the product provider, you are paid a management fee, which is a percentage of the value of the products that you're looking after, or sometimes a performance fee, which is how well these things perform over time, a percentage of those profits. So you have an incentive to ensure that the value of those investments that you manage are as high as possible. And when you don't have an active market for these products, when there's no exchange or no buying and selling that takes place on a regular basis, there's some discretion that is used into the pricing of these underlying investments. And if not properly structured, there could be a little bit too much influence that the manager has on the value of the investments that they're looking after.
Well, this is the one you're going to name, right?
No, there's lots of different product providers that are out there. So there's no one specific to name. And
okay, sorry. I thought you were building to that one specific example we talked about.
No, I'll get there. This is just on private products in general. So generally speaking, there's a disincentive to maybe have full, true price discovery on the underlying investments, which again, you hope, just to take a step back, these conflicts don't necessarily mean that something nefarious is happening. A lot of these companies are doing very, very strong work and being very, very fair with the way that they approach these things. But there's an opportunity for misdoings, if you want to call it that.
Yep. No, look, absolutely. Absolutely. In order for a system to function well, not only do things have to be done properly, they have to be seen to be done properly. So both of those things, because it's a confidence game. Listen, giving financial advice is a confidence game. And if people don't have confidence in the system, then the system stops working. But the problem with this discretion is the bad actors get attracted there. It's like you turn on a light. It's going to attract a certain kind of person. That doesn't mean the person who turned on the lights the bad person. But if a whole bunch of people said, hey, this corner of Bitcoin, hey, the Bitcoin has got all this anonymity attached to it. Great. So anybody who wants anonymity is going to go to Bitcoin. Now, does Bitcoin start out necessarily a bad thing? No, but it attracted a bunch of bad actors. And we've really seen a push. It's been the theme. And it's funny how these investment cycles go. You should invest like the Canada Pension Plan. You should invest like the Yale Endowment. You need private equity. You need private debt. That's really become the cycle. But these cycles don't last forever. And one of the reasons they don't is that they end up developing a track record that doesn't live up to expectations. So as more and more of these things fail to live up to expectations, and we deal with the gatings and we deal with the other issues that come with them, that will signal the end of this cycle and the beginning of the next thing. But the challenge is that when you create something that has more discretion to it, it doesn't mean the people in there are bad actors, but it is a space that attracts bad actors. And so they end up pushing out the light a little bit. And as I said, then performance ends up not being what it's going to be. And then you end up with a bunch of gated products or products that take 7 years to get your money back out of. And everybody goes, well, those products all suck. And they walk away. And there's a couple of good providers there going, but,
yeah,
oh, well, I guess my business is over. Right. And we'll be on to the next idea.
And it is a sad thing, because a lot of times the good's going to get thrown out with the bad, just because people are going to say, well, I walked across that street and I got mugged, so I'm never going down that street ever again, because that whole street, I just can't trust any of it. So that does happen.
Well, and we've been spending a lot of time recently digging into some of this, and I don't want to flex, but we have a lot of really smart people who are going at this really hard, trying to figure out what's real and what isn't. And I won't say we're struggling, but it's not easy. It's not as if we spent 10 minutes on it and go, oh, we got this figured out. These are the good guys. These are the bad guys. This is what we're going to do. I don't know how many dozens or hundreds of hours we're into this, and we're kind of like slow going. Yeah, well, there's some stuff here, maybe. So it's difficult. It is a very difficult landscape to have some success in. But whenever you see opacity, whenever you see somebody who gets discretion on whether they're setting the value of an investment, and again, they will show you a whole list of rules and regulations they have to follow, and tends to be we engineer something that has a conflict in it, then we come up with a bunch of rules and regulations to manage the conflict. And the person who's looks at the rules and comes up with like, oh, they don't have a rule about this, so this is what I can do, right? And then you just end up with this constant evolving rule book trying to catch up to what the perpetrators have gone and done next, right? So it's difficult to watch.
Yeah. Another one that we've done quite a bit of due diligence on and dug into quite deeply is the Brookfield, all of these entities that are associated with it when we're looking at potential additions to our stock portfolio. And so you start reading through some of the prospectuses and you start to notice things that don't sit quite right. And Brookfield, I would say, you think it's fair to say that they've made lots and lots and lots of money for many Canadian and global investors over the years, right? They've been very, very successful at delivering value for shareholders. I think that's fair.
Well, that's more than fair, and they're seen as good operators. Like they're seen as somebody who is a quality shop for sure. But you start digging into some of the prospectuses as we have, and then you start to go, really?
Yeah.
Really?
Yeah. Like they are a very good, solid financial company that, again, has done really great things, I think, for the most part. A lot of what they do is taking various entities in their business and spinning it out of the business as a separate publicly traded entity. But to some extent, they're maintaining an interest, either financially or controlling interest in these entities that they spin out. And it seems like at times they are spinning these things out and maybe retracting these things to the advantage of Brookfield itself, and maybe not the sub entity that it spins out. And so we mentioned reading through prospectuses, and in one of the recent prospectuses, they do maintain a controlling interest in these things. And Brookfield is telling you explicitly in this document that it can use its controlling interest for its own benefit and not the benefit of its other unit holders. And it says very, very specifically in here, this is a conflict of interest. So again, not to say that they're definitely going to do that, but they can if they want to. And that is potentially problematic and makes us a little bit uncomfortable as an investor in those so-called other units.
So how many pages was the prospectus you had to read through to get to that?
Well, I'm glad you asked that, Colin, because that was on page 19 of the 300-page prospectus. So
okay. I have a follow-up question, if I may.
It's not a light read if you want to go for it.
I have a follow-up. What size font was it? 6-point or 8-point?
Well, I'm sitting here looking at my computer screen and it's a little bit hard for me to read. So it's like, okay. I don't know, 8-point font, maybe 9-point, 10-point, something in there.
Yeah, this is when I run up to the cheap seats and pull a bag over my head and start throwing peanuts. I mean, come on. To put product out there, and again, we've been at those presentations where they're launching, and it's a new idea. Like, there's a new sector of something that is really hot, whether it's providing real estate for data centers, or it's green energy, or something that's very, very topical that there's a big market for, and it's going to be very, very sellable. They put something out into the marketplace where they still maintain control, and they can charge that underlying unit for management fees. They can charge it for doing assessments. They can charge it for doing valuations. They can charge it for additional management costs. And they build all these things into it. And it's like, again, and the line that Josh read kind of overarches all of that, saying, we may behave in a manner that conflicts with the other unit holders on page 19.
Well, I'm glad you brought it, because I do think, and it's a little bit opaque to me still after reading through some of this, but it does seem like they can charge the underlying entity for services of some sort as well, whether it's any of those things specifically, I don't know. So then you get, okay, there's conflict number 2. Now here, let me read this for you. Unlike unit holders, there's more. Unlike holders of common stock of a corporation, our unit holders are not able to influence the direction of our company, including its policies and procedures, et cetera, et cetera, et cetera. Consequently, our unit holders may be deprived of an opportunity to receive a premium for the units for in the future through a sale of our company and the trading price, so et cetera, et cetera. So basically they're saying not only might we do something that conflicts with your interests or our interests, but if you don't like it, you can't do anything about it. You can't change the directors of a firm. You can't change the policies or procedures of a firm. You can't change the management of the firm. So even if you're, here, quote, even if they are unsatisfied with the performance of our company.
Yep. Please sign me up. How much of it can I have?
Well, these are the things that lead us to move away from these types of investments when we're really digging into it. I'm not comfortable personally putting my money, your money, any of our clients' money in something where a potential conflict of interests exists that's that egregious, potentially.
Well, and to kind of hit with a hammer the point I made earlier, what they're doing here is they're selling you a new green energy product, or they're selling you a new carbon capture project. They're finding something that's super, super sexy, where they ostensibly do have an expertise in actually, understanding of a particular market, and they do have a good investment thesis, and it looks and walks and talks like an actual investment opportunity. So based on the strength of those stories, and I made all of those stories up, don't know if they conflict with any particular Brookfield product, but the story is what they sell. And then people say, I love that story. And then they'll do, hey, here's what that sector has done for the last 5 years. Here's the projected usage for the next 5 years. And here's the potential growth. That's the basis on which people will make investment decisions here. So by people, I'm putting advisors in that boat too. Advisors will listen to those stories and go, yeah, that's, and then they'll regurgitate the story to their client. The need for electricity in Canada is going to grow at a factor of 4, and it's going to be this billion and that million, and green energy is going to be the thing, and there's all this government money coming into it, and yada yada yada. Wouldn't you like to invest under the strength of our management? Oh my God, yes, please let me invest under your management, because you guys have been around for so long and done so well for yourself, have done so well. The for yourself is assumed, right?
Yeah.
But you never get to page 19 and the 6-point font of a 300-page prospectus to go, oh, wait a second, this is counter to the story you just told me a little bit. Maybe I'm a little less comfortable. So this continues to happen, and the industry still says, "Hey, we disclosed it," and that's what suffices for a defense. And sorry, I don't buy that. I'm going to go back up the cheat sheets and start throwing peanuts. No, that's not good enough. Just disclosing it's not good enough.
Yeah, this is something we need to fix as an industry, in my view, is putting together a 300-page legal document and like the documentation that we have to have clients go through to open an account is just as onerous, right? It's like nobody
Yeah.
can understand this stuff. So we call it a legal document, or that it was documented or signed or whatever, and say that it was disclosed or reported or whatever it was. But we can't expect people to try to understand every nuance of these documents or try to read every nuance of these documents. It's become overly litigated, in my opinion.
Yeah, no, absolutely. But again, the strength of the stories that can be put out there are substantial, and that's going to continue to garner interest from the public who want these stories, who want this hope, and so there's going to be a demand for this kind of stuff, and it's very profitable to provide to fill that demand.
Yeah.
So there's always going to be organizations that are trying to put forth products that can take advantage of it. Listen, it's much harder to stand in front of a room and make fun of investing in marijuana like I did back when marijuana was going legal. That doesn't pay as well. Telling people not to do something is not as profitable as letting them do something they already want to do. And that's very much a cornerstone of the industry, unfortunately.
Yeah. I have a couple more quick hitters here for you. We should.
Oh, there's more
Less
conflicts.
time. There's more.
I'm conflict drunk.
I've narrowed it down as much as I can. There's so many out there. It's so easy to find. But one of the other ones I think is, again, I have a hard time saying this is negative at all times, but anytime that it's more of a transactional type relationship and there's a commission earned, and the commission is a percentage of the value of the product. And a big part of this is mortgage brokers or life insurance agents or something along those lines. It's like the incentive is to get you to borrow as much money as you possibly can, or to get you to buy as much life insurance as you possibly can, because then your commission check's higher. And that's, again, it doesn't necessarily mean a big mortgage or a big insurance policy is wrong for you, but you better make sure as a consumer that the individual suggesting this is doing a really good job of understanding what your needs and priorities are.
Yeah, no, I think you raise a good point. Anytime you're entering into a transactional relationship with somebody, like I'm going to go to you and you're going to sell me something, and that's the end of our relationship. That's when your radar is going to be whipping around as fast as it can go, because that person demonstrably doesn't have much interest beyond that meeting with you, beyond that transaction. Now, it's a little different if you're dealing with somebody, an advisor who you meet with every year. They're going to have to, the idea is they're going to have to face you a year from now if this doesn't work out. So you kind of hope, or you ought to have more hope, or reasonable to have more hope, that you're a little bit better protected there. But if you're just going to get a mortgage, like you said, they're getting paid on their mortgage volume. Most of them are. And, again, worst financial advice ever given. This is a story told by our team member.
Yeah.
You need to buy the biggest possible house you could possibly buy and get the biggest possible mortgage. And, hey, real estate always goes up in prices. Houses are tax-free. It's the best investment you can possibly make. Why wouldn't you buy the biggest possible house? Now, the first victim of every great fraud is the perpetrator. So that person may actually believe what they're saying. But the reason that that echo chamber believes that is that that's for the best interest of that industry, and so it's reasonable to argue with it. But that's absolutely true. Transactional relationships are way more fraught with this kind of thing than longer term relationships.
Yeah. There's one more I have to mention just because it's so near and dear to our hearts. It's maybe ending more with a whimper than a bang, but sell side research. So when we talk about sell side research, it's more investment banks around, really probably this is a global thing. But this is where you read the paper and say, analysts at Bank of America have cut their price target to $53 on shares of Apple. Almost always they have buy recommendations, these analysts, on every stock that they follow.
This was my question. What percentage are sell?
I think it depends on which data set you're looking at, but it's like 2%. It's like we're in the
I
single
had seen
digits
3.
percentages,
Yeah,
right?
exactly.
So how can you want to invest in 98% of the potential stocks that are out there, or whatever the number is, right? 90, 95, 98, it's still egregious. So that is a very clear and obvious conflict of interest somewhere along the way. And we know what it is because these investment banks are trying to promote the stocks of companies that might come to them to sell their shares to the open public.
Or banking or other whatever services, right? If they're getting good coverage from one institution, then that institution is going to go to that company and go, "Hey, we've been real nice to you guys." And again, it gets printed as news. Like
Yeah.
it gets printed as a news item. Like, so when you see it, it's like, "Oh my God, this analyst has downgraded or upgraded this particular company." And everybody goes like, that's big. It looks like news. It's not news. It's selling. Like it's the sales department just put out a news release and it's getting covered as if it's actually meaningful.
Yeah.
Now, to their credit, they're all CFAs and they put all kinds of fancy words and calculations around it that are very, very useful. But that whole thing, again, my number is 3 years is 2. There's not many times that they stand up and say this is a bad company. Like that's just not what they do because it doesn't work.
Yeah. These people are really smart and often they have really good insights to business, but they're not good at telling you when to buy and sell stocks. They're just not. And these institutions, organizations have launched products based off of their sell side analysts in the past, and they've been a complete and utter failure because there is some inherent thing we won't even call it a conflict, some inherent thing in what they do that prevents them from making good recommendations on when to buy and when to sell.
So, was that your last point?
Yeah, I'm kind of sad now. I need to go cheer myself up.
I need to go pat a puppy or something. But we have to leave our listening audience with a lesson here, Josh. I don't know how we want to frame the lesson. Be careful. Understand the business model of who you're talking to. Come talk to us, and we can tell you more stories about the conflicts. If you don't think there's a conflict in your world, show it to us, and we'll find the conflict for you. Hey, we should have a conflict finding service.
What I don't want to do is discourage people from seeking out professionals because that could be problematic as well. The conflicts potentially exist in everything that you do. Like we just did our roof on our house. Like there could be conflicts there with sourcing proper roofing companies as well. Like it's going to be there for you. And it doesn't mean you totally like just turn around and go the other way and head home and forget about it all. It just means you need to be a little bit more aware, questioning.
I think if you understand the conflict that's in front of you, then you're more apt to have a reasonable expectation as to the outcome. And you're not going to be able to understand. And it's funny, I will foreshadow an upcoming podcast because some people have turned to AI to get financial advice now, which I'm quite interested in, to be quite honest. So people are trying different things, but it's still worth trying. Understand the conflict that's in front of you. And if you pay attention to the motivations of the people you're getting advice from, you're better off. As to how sad you get, because I too am very sad right now, Josh. We're sorry about that, but it's better to be aware than happy and unaware, right?
Maybe.
Say yes, Josh. Say okay, fine. Maybe it's better to be happy and unaware. You should erase the entire podcast. Let's not even publish it.
Well, you got me thinking about next podcast now, because does AI have a conflict? Stay tuned for next time. We'll tell you.
There you go. Great ending, Josh. If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening. Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.